Hi everyone, welcome to today's webinar, Filling the Void, Fuel Oil's East-West Trade Displacement in the New World Order. Thank you for joining us today. I would like to start with few housekeeping rules. So questions are going to be attended during the last 10 minutes of today's webinar, so feel free to post your questions in the Q&A box. You have access to them too in the toolbar at the bottom of your screen, where you will have access to most of the resources like the speaker's biography as well as the webinar material. Some of the key discussion points in today's agenda are going to cover changes to Russian fuel oil production, as well as the impact of trade displacement on fuel oil price dynamics. And without further ado, I would like to present our two speakers today, our senior oil analyst, Timothy France and Emerald Jamil. And Tim, to you.
Fantastic. Thank you. Thanks very much, Maitab. Thanks everybody for joining us. So, as just reiterate, my name is Timothy France. I'm a fuel oil analyst here at Refinitiv. Generally speaking, I'm covering Middle East fuel oil markets. I was actually one of the lead authors on the Global Fuel Oil Report we published recently, titled of today's presentation as well. So today what we're going to do is we're going to share with you a few of the highlights from that report. And we're also going to update you on some recent market developments we think are noteworthy. So we'll start with an overview of the political landscape and the changing procurement policies as we see them today. Then we'll drill down on Russian refinery operations and exports, and we'll explore how trade flows are adjusting to the new sanctions regime. After that, we're going to go market by market. We'll look at the changing market fundamentals and also some of the price dynamics. So yeah, if you have any questions at all as we go, just put them into the chat and we'll get to them towards the end of the session. So just to delve in immediately to the sanction side of things, the EU, UK and US are leading the way on sort of, quote, restrictive measures on Russian entities following destabilizing activities in the Ukraine, to use the language from recent EU sanctions. So Western allies, they're obviously employing a variety of sanctions tools that target Russian individuals, companies and government entities, and we presume that's to inhibit government revenues that could be used to fund military operations. Now, with respect to the oil markets, arguably the most significant of these sanctions tools include exclusions from the SWIFT payment system, sanctions against Russian banks and oil companies, as well as import bans on Russian oil. The chart here, the table here, just illustrates some of the key tools that have been deployed so far and by which nations. So, yeah, these sanctions, they prohibit the import of Russian oil. They also impede trade finance and they complicate shipping operations. Now, the US and Canada, they were the first to issue import bans for Russian oil. They were followed shortly and quickly by the UK and Australia. I think Japan is still on the fence, still considering a ban on how they're going to go about it. And then the big news earlier this month, obviously, is the EU ushering its oil embargo of its own in the 6th round of sanctions. So it's critical, really, because many of these countries are major oil importers, but they're also really key markets for Russian suppliers who essentially really now have to go out and find alternative buyers. There's really significant implications for a lot of Western companies as well. Just to look at the international oil majors, you've got BP, Royal Dutch Shell, Total Energies, Equinor, ExxonMobil. They've all announced plans of some description to essentially wind down their interest or involvement in Russian production and Russian oil trade. So we're talking about sort of divestments from upstream projects, non-renewal of term contracts, and also a halt on spot trading of both crude and refined products. So that really underlines the significance of the international sanctions and also their implications for companies doing business in Russia. But I think actually really also more telling was the sort of later and subsequent announcements from some of the global trading houses, the likes of Glencore, Gunvor, Trafigura and Vitol, all taking measures to essentially wind down their interests in Russia as well. I think some of the announcements, the general theme of the announcements they made was that term contracts will be honoured, but they won't engage in new ones, nor will they engage in spot trades. That's obviously not insignificant because these trading houses, basically over the last 10 years, have taken a really dominant position in the Russian export market. We've seen quotes for Trafigura, for example, handles around or up to 500,000 barrels per day of crude and products, but obviously that's unconfirmed by Trafigura themselves. So what we see happening essentially is that as these key Western players sort of exit the market, that's going to create a void and opportunities for alternative trading companies to step in. So the EU decision in June to phase in a ban on Russian oil imports is probably the most significant move so far, given the level of dependency that the region has on Russian energy supplies. So just to sort of abbreviate, I suppose, under the new laws, by December 5th, imports to European states of Russian crude oil will have to be phased out and halted. And then we see the same thing happening for refined products, including fuel oil. And the deadline date for that is 5th of February 2023. So you've got an 8-month window as of the start of June. So what does that mean for physical flows into Europe? Well, essentially, term contracts predating June 4th can be honoured, but no new contracts can be signed. And then short-term spot purchases, we believe, can continue up until deadline day. Just quickly, I mean, there are exemptions, I'm sure many of you are aware. I think we've got Hungary, Czech Republic, Slovakia still able to receive their crude supplies via the Druzhba pipeline. Technically, Germany, Poland can as well, but they're going to be voluntarily finding alternatives. And then Bulgaria, Croatia, they both have sort of a longer time frame to wind down imports of crude and VGO respectively. But ultimately, in terms of market impact, I think general sort of assessments come in that about 90% of Russian fuel oil imports to Europe, sorry, not fuel, but crude and refined products to Europe will essentially cease as a result of the new sanctions. I think one of the other things that came up in the latest round of sanctions I wanted to address at the top of the session, it relates to the new shipping sanctions, and we've got a quote from Article 3 here as well. So the US, UK, EU import bans, they don't necessarily prevent non-domiciled traders from buying Russian oil and selling it to other countries, third-party countries. However, EU sanctions that are now going to be targeting the shipping sector, which are expected to be sort of phased in over the next 6 months or so, they could actually have global implications for the Russian oil trade. Now, this is because shipping oil cargoes requires protection and indemnity insurance and reinsurance. Now, without that, it's our understanding that most charterers will not actually be able to necessarily book a ship, and a lot of port authorities will not allow that ship to enter its jurisdiction. So you can see some serious impediments to moving cargoes as a result of that. Now, the reinsurance market is actually relatively small, and that's provided by a small number of P&I clubs, and most of those are actually based in either the UK or Norway. And because the UK companies potentially have EU subsidiaries, or Norway has equivalent rules in terms of EU trade policies relating to its trade agreement, the expectation is that these companies will also follow suit and abide by these sanctions on shipping. So what that means is that a large number of charterers that may wish to move Russian oil would have to find alternative PI insurance providers if they wish to engage in trade. Just important to note as well, this sanctions tool was probably one of the most effective means of restricting the Iranian oil trade in the sort of latest round of sanctions, which are obviously still ongoing. And that's had a serious limitations on the ability of traders to engage in Iranian oil trade. So just, if we can sort of get an idea of how that might impact the markets. I mean, one of the shipbrokers, Poston & Partners, recently put out a survey or a research piece suggesting that due to the tonnage restrictions that would essentially result from this new sanctions regime, total Russian exports could fall by as much as 50% if not more, towards the end of the year. So you can see that this really creates a potential inflection point for the Russian fuel oil exports and crude as well as other refined products. So yeah, we're just going to go to the big picture here. So Russia is obviously a major exporter of crude and refined products, and the data really tells the story here. This is 2021 averages from Russian customs, actually, and we had an average of nearly 7 million barrels per day in combined crude and refined products. Obviously, major exporter of fuel oil, major exporter of middle distillates as well. Now, since sanctions were imposed, Russian crude output has fallen, refining capacity has been reduced, and export volumes of these products has also fallen. In terms of what this means for global markets, well, we've seen all the price volatility that's ensued since late February, but just to try and put a few numbers in terms of supply demand, Russian crude output, I think it was about 1.25 million barrels per day, short of production target as per OPEC plus guidance. And OPEC overall was 2.5 million barrels per day short of target in May. So obviously there's a significant deficit in terms of crude supply, supporting Brent prices here. And then to middle distillates as well. Refinery closures in the pandemic combined with resurgent demand has resulted in a global shortage of refinery capacity. And as a result, we've got booming product prices, very strong crack spreads, particularly on the middle distillate side of things. Now, that's feeding in, obviously, to the VLSFO market, creating a shortage of cutter stocks in many areas and supporting both prices for the 0.5% marine fuels and also the crack spreads as well. But yeah, we're going to take a little closer look at the heavy distillates now. I will start with refinery activity and fuel oil production. Recent data shows a dramatic decrease in Russian refinery capacity since February. Operating capacity fell by from 90% in January to around 60% in March and April. You can see the top table there. So we attribute this largely to heavy seasonal maintenance and some plant closures. We think that Russian refinery operators were forced to cut runs as international buyers backed off Russian supplies, meaning that a lot of export-orientated plants couldn't ship into the market and had to cut back. So if we look at the May data, that's quite interesting because in terms of refinery capacity, we sort of see an increase in availability to 71%. And that would bring back an estimated 500,000 metric tons of potential fuel oil demand. Potential fuel oil production capacity within Russia, just based on primary processing units. General reports that we're seeing in the press, they kind of confirm this as well. So it's starting to suggest that the closures of refinery closures in Russia may have actually bottomed out in April, begun to recover in May and June. Now, I think really one of the critical developments here that we've seen about recently is the restarting of the 240,000 barrel per day Tuapse refinery. That's in the Black Sea region. And that's important because essentially it's a Rosneft operated refinery. Rosneft obviously itself a target of sanctions. That was initially shut down in March because they couldn't shift the products onto the export market. The fact that refinery is now coming back online indicates that they might have found solutions. So quite an important indicator there for Russian fuel oil exports and Russian exports going forward, let's say. Let's turn to the bottom left chart. That shows Russian fuel oil exports on a monthly basis, and they've fallen subsequent to the conflict in Ukraine. We're down on average about 1 to 1.2 million metric tons per month. This does actually kind of coincide with the data that we see in terms of lost refining capacity. So as that refining capacity returns, there is the potential that those exports could start to creep up again. May data indicates that may already be the case. Now, sustaining those exports, sustain those export volumes, obviously requires Russian suppliers to find alternative buyers as US and European markets close their borders to Russian cargoes, and sanctions, particularly on the shipping side, start to bite into that third-party trade as well. We can look more specifically at the trade flows in a second, but before doing so, I just want to draw your attention to the table on the right-hand side there. That's the sulfur content of Russia's April fuel oil production. And what you can see there is about 78% of the output in April was of a sulfur content exceeding 2%. The implications of that is it just shows you the nature of the Russian fuel oil grades. So when we're talking about Russian fuel oil, we're really kind of focusing on the high sulfur story here. So these are the trade flows. This table is also taken from the report we issued recently, updated from May data as well. We're comparing the averages between the pre-sanctions or pre-crisis and post-crisis periods. Ultimately, we see that Russia's sort of maintained overall exports at about 80% of the pre-conflict levels. And then we come to compare the interregional fuel oil flows for Russia, as well as the implications on the knock-on effects that might have. So, focus first of all on the US. Flows to the US down by 900,000 metric tons per month in the comparison periods. Obviously, as a result of the import ban in April, that import number's fallen to zero since then. So obviously the average is going to decline. We are now at zero in terms of Russian fuel oil flows to the US. The bottom row shows that those US refiners, they've pivoted to Middle East supplies, as we expected they might. And flows between the Middle East and the US up by 483,000 metric tons per month. And we look at Northwest Europe. Europe is both actually an importer, but also a transit point for Russian fuel oil, with Rotterdam as the major trading hub. Imports to Northwest Europe, they're down after re-exports to the US have fallen off, and also as companies wind down their involvement in sanction due to sanctions risk, and also a level of self-regulating. We'll discuss that more in due course. Meanwhile, European fuel oil flows to the US, down 163 KT a month. Again, we think that volume probably largely represents transshipments of Russian origin products as well. If we look then to Southern Europe and the Mediterranean region, flows to the Med at this point are more or less unchanged, which is quite interesting. We definitely think that imports in terms of onshore discharges to major Southern European buyers, countries, they have softened. However, we see a massive increase in STS zone discharge at Kalamata, Greece. That's now surpassed Malta as a major offshore trading point for Russian fuel oil. In the Middle East has emerged as a key buyer of Russian fuel oil. It has actually traditionally been one. It's been an off-taker of Russian fuel oil for many years already. Saudi takes high sulfur fuel oil to its power plants, and Fujairah does receive cargoes for the blending and redistribution. So these flows to the Middle East, they've definitely increased, while Middle East flows to the US, as I mentioned, they've also increased. And then quickly to Asia, direct flows of Russian fuel oil to Asia, they've increased, Russian fuel oil flow to Asia, they've increased since the conflict began, so there still appears to be some willing buyers there. Meanwhile, fuel oil flows from Europe to Asia, they've fallen away. We think it's largely due to Europe relying more on its own supplies to replace Russian cargoes. And I think there's also a low sulfur story here as well. Potentially a reduction in low sulfur flows from the likes of North Africa onto Singapore. So these, just general patterns, they all feed into the sort of east-west displacement we've described of the fuel oil trade flows as Russian barrels are backed out of US and Europe and priced into the Middle East. So, just a quick look. I mean, there's similar data, but we're going to drill down country by country so it can sort of be a bit more specific about it for you here. So we see that the US has been replaced by Greece as the top destination for fuel oil cargoes loaded at Russian ports. Netherlands, it remains a key transit point. European end users, including Spain and Italy, they've slipped down the rankings, as have the transit points of Denmark and Malta. Middle East countries, you can see on the right-hand side, they've moved up the rankings. UAE, Egypt, Saudi Arabia, all increasing offtake volumes in the post-conflict period. And in Asia, we see somewhat significant increases in Malaysia and Singapore, increases, but to a lesser extent. So we'll take a look at the markets by region now. So this is the US. I'm going to hand over to Emril now. He's going to take you through a few observations we have for the US market. Emril, do you want to take over from here?
Yeah, thank you very much, Tim. So what we are seeing is that, as we can see, supply from the Arab Gulf to the US has increased tremendously, as Tim has reiterated. And the chart below on the green shows the massive decline of European fuel oil to the USA by departure date. So it fits into the story that the US is not buying anything from Europe, which is predominantly Russian fuel oil. From data that we have, June imports into the US is about 96,000 metric tons only. And in April and May, there was nothing that was imported by the US from Europe. So it's a tremendous decrease that we are seeing because of the conflict. And it has certain repercussions going forward, at least in 3 months. Yep. Tim?
Yeah, thanks. So I'll pick up on the European side. Yeah, just quickly back to the US side, just to comment quickly a few additional points. I mean, you see that the increase in the Middle East flows. It's totally replacing the Russian imports. You see the bottom chart there. The red represents Russia, then the light blue, you see the uptick in the Middle East there. But overall imports decrease quite considerably. So I had a chat with the guys, our US team over there. So overall imports are down. There is a correlation there with reduced coker capacity, because our understanding is that the cokers are really what drives the feedstock demand for imported high sulfur fuel oil in the US. Yeah, I mean, the numbers there, we see some coker.
Yep.
Hi everyone. So just we are having some technical issues, so can you please bear with us? It's going to be sorted out quickly. Thank you for your understanding.
Hey guys, sorry, can you hear me again? I just had lost connection.
Yes, we do, Tim. Thank you.
Okay, back online. Okay. Right, okay, so yeah, here we are, European markets. Sorry for the delay, interruption. So yeah, take a little closer look at the European markets. Flows data shows onshore fuel oil discharges at European states. So check out the bottom table there. So Netherlands is currently maintaining Russian fuel oil imports, as we alluded to, and I think that volume is likely to fall off in the second half of 2022, and we foresee some key drivers for that. So there's a strong possibility at the moment that the tank leases, ARA for example, are held by Russian companies or companies with term contracts for Russian supply. So that would be still supporting the import volumes for the time being in the short term. And then later in the year, we expect those term contracts to roll off and Russian cargoes will essentially move into the hands potentially of alternative trading outfits. I think those contracts are due to expire, a lot of those, towards the fourth quarter of the year. Now, when the shipping sanctions take effect in December as well, that also could create another logistical obstacle, difficulty for the movement of Russian cargoes. And then as of February 2023, when the import ban kicks in proper, obviously the movement of those barrels into ARA, we'd assume will be essentially illegal. So as we see at present, ARA inventories, they're still within their 5-year range. Trade flows trade flows incoming to the region of Russia are still there. Now, if we consider other EU states, particularly more the end user markets, then they are reducing their purchase of Russian fuel oil. UK, Germany, Portugal, they appear to be reducing their offtake pretty quickly, albeit from relatively low levels. And I suppose as well, when you're relatively lower imports and you're talking 2 cargoes a month, it's generally easier to go out and find an alternative supply. A little bit more flexibility. Russian fuel imports to Spain, they've come off quite sharply. We'd assume that's probably because Repsol is sourcing alternative feedstocks as well. And that'll be for their coking units, which have relied in the past quite significantly on Russian fuel oil and VGO. Then Italy and Greece, these guys are a little bit slower to adjust. And there's a good possibility, I think, that those imports inflows will continue as Russian spot purchases are permitted up until February next year. So you can take advantage of any discounts that might be available on those cargoes and boost your margins that way. So anyway, the trend we're seeing is that Europe is importing Russian fuel oil, which obviously serves the bunker, the marine bunker and the refinery feedstock markets. Now, the loss of Russian imports means that buyers must either cannibalize their own supply or regional supply, or they've got to source from elsewhere. The likely and alternative sources of high sulfur fuel oil come from the Middle East and possibly Central America as well. Obviously, this would put European refiners, if they were to go out and source these cargoes, or European traders, in direct competition with the US buyers, as we've already mentioned, and that could really possibly support the bid on those cargoes. So if we just then consider prices in Europe for the time being, high sulfur prices, they're telling, we're talking essentially about a tightening market if you can't buy Russian fuel oil. But prices on HSFO, they're telling a slightly different story at the moment. So European high sulfur crack spreads, they've actually softened considerably in recent weeks. And weakness in the European cracks, I think, is partially driven by the relative crude strength in crude prices, admittedly, but there is some definite softness in the HSFO market, and you can see that in the ARA swaps there, which are actually in contango. Now, one factor we think is driving that is the return of European refineries from spring maintenance. So obviously you've got that increased capacity available. You've also got refineries running at we see very high utilization rates. Which means, just increasing local fuel oil output. This obviously coincides with a build in inventories. Again, the bottom right chart there. So that could also be partially Russian barrels waiting for export. So Russian exports, they're actually also on the rise for the time being as well. We saw that earlier. So that's adding to the supply factor in Europe at the moment, again, potentially adding weight to those prompt contracts. And then I understand that a lot of the pricing agencies may also be factoring in Russian cargoes into their assessments. Now, there is obviously the possibility that Russian cargoes are being discounted relative to alternative high sulfur cargoes, potentially leading to a two-tier market. If that is the case and the Russian cargoes are included in the price assessment, that could obviously add a depressing factor to spot prices. On the low sulfur side of things, I'm going to hand over to Emeril again in a moment, but yeah, that tells a different story entirely. We've got very strong crack spreads on low sulfur in Europe. Prices are very strong. And again, that's essentially the tightness in the gas oil market feeding through to the low sulfur complex. So, Emeril, you've got a few ideas you want to share with the audience here on that.
Yeah, continuing from Tim, we think that the middle distillates Russian barrels are going into the fuel oil pool or marine fuels. As you can see on the chart on the left-hand side of the triangle, up to the conflict, you can see that there was a rise in Rotterdam gas oil inventory. As we move towards right up to April, then it starts to draw. On a delta basis, on month-on-month, we can see that in April, the inventory in ARA gas oil was down, so is the fuel oil. But as we move forward to May and June, an inversion happened with more inventory of fuel oil in the ARA. We believe that because of the discounted values of Russian middle distillates, which is round about being talked in the market around to about $20 to $40 per metric ton, this provides good economics to blend it into maritime fuels that will fit into the 0.5 LSFO or VLSFO market. And it can depress the VLSFO term structure going forward. Yep. Yeah, and due to this, there's a potentiality of the viscosity and the scrubber spreads narrowing. We can see that it hit a peak for the July visco at about $61 and now it's trending lower, as well as the 0.5 versus 380 CST, which is the scrubber spread, hitting a high of $371 per metric ton and down to current about $40 per metric ton. And why is this happening? As more middle distillates being assumed to be blended into 0.5 with tight availabilities of components for 380, the 380s will dominate the 0.5 market. So we would expect to see a narrowing of these two spreads going forward. And I think it's happening at the moment together with, unfortunately, inflationary risk that's being taught globally. Yep.
Okay. Yeah, thanks, Emeril. Great. Okay. So getting towards the end of the session here of the presentation. So this is a slide obviously representing the Middle East market. So after Russia, possibly Mexico as well, Middle East countries do appear to be the major exporters of high sulfur fuel oil. So regional export data shows US buying has increased significantly in March and April. As flows were diverted west from the Middle East, flows to Asia fell off quite considerably And that added to, that created a period of quite considerable tightness on the high sulfur market in Singapore during March and April. That was reflected in the prices. So the chart on the right-hand side, there, top right, that shows the Middle East spot prices, relative spot cargo prices in the AG relative to Singapore. So it's essentially looking at the Singapore price premium on AG cargoes. And then what you see, there's also the freight rate for Aframaxes from the Middle East to Singapore. And it's just to highlight the very, very close correlation there are. And the point here is that if we're talking fuel, if we're talking prices for the Middle East in terms of fuel oil, Singapore is really, the key market we need to be paying attention to. So when Singapore prices are high, so are the Middle East prices, and that's going to potentially have implications for arbitrage flows both east and west. So what we think is that as US purchases of Middle East fuel oil increased, supplies to Asia obviously fell. That created some tightness and lifted prices in Singapore, essentially closing the arbitrage from what you might the price spread between Singapore and the US Gulf Coast for a sort of high sulfur 3.5%, 380 type fuel oil. So as that arb appeared to close, that seemed to have squeezed US buying to some extent, but there could obviously be other reasons for that. Whereas the US has essentially backed off to, the Middle East cargoes in the last month or so, particularly through May. Essentially, those Middle East cargoes have gone to Asia instead, and we've seen a considerable build. So there's been a strong swing in the flows in that period, and that's been reflected in the arbitrage pricing. I think at this point, we're starting to see that arb from essentially the Middle East to Asia the Middle East to the US is starting to look a little bit more favourable at the moment. That could open up more purchasing from the US side for July and August deliveries. Our early indications for data in the next few weeks suggest that there are a couple of fixtures from the Middle East to the US, so we could already start to see that materializing. So if we just sort of think about the Middle East in general in terms of fuel oil output, fuel oil exports, your key producers are ultimately Saudi Arabia, Iran as well, and Iraq. Now, for US and European buyers, Iranian fuel oil is obviously not an option. So that really leaves, the Iraqis and the Saudis as potential suppliers. Although interestingly enough that ADNOC had actually stepped up and delivered a few straight-run fuel oil cargoes over the recent months. Ordinarily, they have pretty solid, sophisticated refinery equipment, and often not the case. You don't often see many fuel oil cargoes from there. So that was a slight deviation from normal trends. So as Middle East exports increase, we're essentially seeing and observing an increase in Russian fuel oil arrivals to the region as well. So if you look at the bottom chart here, it shows a ramp up in Russian cargoes directly loaded at Russian ports, discharging in Egypt, Saudi, and the UAE. So obviously they're up considerably since the conflict began. But if we look at the historical data here as well, also in line with seasonal patterns. And this is being driven by demand from the power sector in the Middle East and also South Asia. So the question then is can these imports essentially be sustained beyond peak summer demand? The Middle East seems to be emerging as an alternative market and trading center for Russian cargoes, that's for sure. And as such, we've already observed a significant increase in trading activity in Fujairah, which is a key terminal trading center for the region. There's been a rapid turnover of cargoes there and a turn on the molecules in the tanks there, which remain moderate. The inventories there, they remain moderately stocked, hovering below the 5-year average. So just generally speaking, in terms of the trends, we're seeing an increase in westbound fuel oil flows from the Middle East, and we're seeing now counterflow a Russian flow to the Middle East and also to Asia. So this pattern really underpins the assertion that Middle East-based traders could potentially step up and step into that Russian fuel oil trade as the dominant players that have been there for many years potentially step aside or forced to step aside as a result of sanctions. So that kind of, I guess that wraps up the prepared slides and the presentation. I'll hand that back to you, Maitab. Maybe you can open the floor for questions.
I just would like to add something that Tim has said. With the higher middle distillates proportion going to possibly into the fuel oil and being exported into the Middle East, it becomes very difficult to track what is the Russian origin fuel oil, and then it becomes flush with more 0.5 into the Middle East, and as it becomes a middleman that can be exported to other regions, especially into Asia. So we are expecting a bumper crop of fuel oil coming here to Asia as we head into July to August period, and the spreads for the 380 and the VLSFO has shown some weakness ahead of this period. Yeah, sorry, Tim.
Thank you so much, Emeril and Tim, for a very interesting webinar and for the added value that you've done today. And we are going to jump to the Q&A now. And I encourage everybody to share your questions in the Q&A box. You will be able to find it in the toolbar at the bottom of your screen. And we already have a few questions. So, Emeril, if you would like to take this one. So, vessel tracking providers like Vortexa is still showing companies like Vitol bringing Russian fuel oil to Rotterdam and Antwerp. On the other hand, Platts has not limited Russian fuel oil origin on their fuel oil 3.5% S on their trading window. Do you think that Platts will limit the Russian oil in the window? Do you know why Platts have not limited Russian oil, even though many buyers are already self-sanctioning Russian fuel oil? Thank you.
A very interesting question. Yes, for the moment up to February 2023, as Tim has reiterated, there is a possibility that you can still load Russian fuel oil or Russian refined fuels, but for the other publishing like Platts, I cannot answer them, but eventually, if it falls under the preview of the US and European legal system, then they would potentially have to consider Russian origin fuel oil to be excluded in their assessment, as it create a dislocation of price discovery and price mechanism. It has not happened yet. I mean, ICE Exchange, for example, as everybody has known, that has issued that, on their take for ICE gas oil for the exchange. So it is something interesting that we are looking at, and how price discovery publishing houses are going to move forward with Russian origin as the articles for European and US sanctions take into effect. I hope that answers your question.
Thank you, Emeril, so much. Tim, the following question is going to be for you. So given the drop in the US oil imports, is there also a decrease in US feeds demand as the market does not seem to be tight for HSFO? Tim? Can you hear us? You are on
Sorry,
mute,
yeah.
I believe.
Yeah. You can hear me now?
Yes, we can. Thank you.
Okay, yeah. So, yeah, regarding feedstock demand in the US, has that fallen essentially in recent months, and is that creating a potential weakness on the high sulfur side of things? So I had a chat with some of the US team internally, and the key driver for high sulfur fuel oil demand, and certainly imports in the US, is the US coking capacity, which is obviously centralized in PADD 3 on the US Gulf Coast. That is not insignificant coking capacity. I think is around 2.7 million barrels per day in terms of capacity. There has been some maintenance there recently, but it's relatively small. I think in terms of capacity, it drops. It dropped from about 2.7 million barrels per day to around 2.5 million barrels per day at the peak. So in terms of offline capacity, it's not going to make a huge dent in demand. So ultimately, that feedstock demand should still be, that capacity should still be there and able to drive feedstock demand. I'm not absolutely sure what's driving the cracker market or the coking margins in the US at the moment. I mean, general conversations we have is that they're generally speaking, pretty strong. That's driven by pretty strong crack spreads on gasoline and potentially middle distillates as well. This is obviously peak seasonal demand for US oil. This is the driving season, so I'd expect those cracks to be strong as well. So if ultimately, I think as well that the utilization rates, not only on those cokers but generally across the US refining system, is being totally maxed out at the moment. So if you take those factors into consideration, then the feedstock demand should really be surging. So therefore, why are the imports down? Why might there also be potential softness on the high sulfur side of things? Well, what we've understood, or what the feedback I've had from the guys in the US is that essentially that the refiners are tending to lean more towards their stocks at the moment. So instead of potentially going out and buying, purchasing high sulfur cargoes for their feedstocks, instead they're drawing down on their residual inventories. If you look at the inventory data that I pulled up, that I showed earlier, there is definitely a sort of decrease, generally speaking. There's a downtrend in those inventories, but it's not a huge amount. I think the inventories for residual fuel in the US at the moment they were around the 30 million barrel level. They kind of dropped now to around the 27 million barrel level. Now, if you take into account the amount of coking capacity, you're only talking about sort of 10 days cover or so, forward cover. So the amount in stock as per IEA numbers is not necessarily a huge amount in terms of forward days. But maybe those draws are sort of easing the overall demand and creating some softness in the market as they use those alternative supplies. And I don't know how much longer that might last for in terms of giving you an outlook, but it's the best way that I can probably rationalize perhaps the disconnect you're seeing in prices at the moment. So I hope that helps to sort of give you at least some insight and some ideas there as to what's driving the market.
Thank you so much, Tim. This was very interesting to know. I believe there is another question for you as well. So thank you for your interesting presentation. You are welcome. It is worth looking at the trade flow change. Do you expect Russian exports of crude and refined to decrease more in the coming weeks and months? If yes, by how much versus pre-war period?
Yeah, I wish I had a definitive answer to that one. I don't think I could put a number on it. Okay, so again, probably look at the Netherlands and the ARA inventories as sort of a key driver, or a key bellwether. Obviously, those imports are still happening at the moment. That's obviously providing a key off-taker for the Russian supply, for Russian exporters. Who's the potential then, if they gradually fall off, essentially for the reasons that we discussed? You've got the shipping sanctions, you've got the term supply falling off, you've got those Western traders essentially making commitments not necessarily to take any further spot purchases. So obviously that's the void that it creates. So it does therefore require the Russian suppliers, Russian exporters, to go out and find an alternative buyer who is going to continue buying those. At the moment, I think the Middle East have increased imports. They are still willing to buy. India is still willing to buy. If that demand disappears for whatever reason, then where is the alternative market for Russian supplies? You don't see a potential alternative. Therefore, that would necessitate run cuts at the refineries because many of them are export driven. That in turn is likely to have a knock-on effect for production, potentially speaking, because the onshore storage, obviously for crude in Russia, is limited. So you would expect to see a decline in Russian production, Russian exports, if they cannot find those alternative buyers. I think in terms of, we were discussing here in our office, India has been mentioned as a key alternative off-taker. They have increased their crude imports. Fuel oil imports, I have to say, somewhat negligible. But we don't see any policy impediments at the moment coming from the Indian government to prevent those purchases. They receive those cargoes, we understand, on a CIF basis. So ultimately, they're putting the shipping responsibility on the supplier. So the question is, therefore, can those suppliers do to deliver? That's when the shipping sanctions are likely to bite. And to say that could be really a deal breaker, I see as a potential inflection point. So unless the Russian suppliers can find shipping solutions, then I'm going to have to sort of default to some of the sort of more general market commentary and estimate shipping specialists will say that a 50% decrease in Russian exports is a feasible expectation, and that's the best sort of guidance I can give you over the next 6 months.
Thank you so much for this. You want to add anything else? Perfect. So, Emerald, the coming question is going to be, yes, please, Tim, you are saying something?
Oh, no. Let's go. That's because the next question. It's fine.
The next question, Emerald, it's for you. Why would companies blend Russian gas oil into VLSFO in ARA when gas oil cracks are so strong?
From our understanding is that once they draw down inventory, and as this sanction bites into next February, the flows for middle distillates or gas oil has nowhere to go. And given that those cargoes are being bought at deep discounts, the most likely a higher proportion of it will be of Russian origin gas oil. Yep.
Thank you. Tim, this question is for you. Are the Russian cargoes arriving in the Middle East potentially being sent on to the US?
Yeah. I don't think that's happening at the moment. So just generally speaking, the volumes of the overall volumes of Russian fuel oil arriving to the Middle East are still relatively low. Those cargoes, I'm tracking those into the end use points within the Middle East. So we're talking about Saudi power stations, or we're talking on Kuwaiti power stations as well. And then some are coming into Fujairah. I think the chances are that those Fujairah, once it gets commingled in Fujairah, we see strong purchases coming from Pakistan at the moment. So there's a good possibility those cargoes are being blended and sent on to Pakistan, and Vitol is a key market participant there. So no, I don't think they are being re-exported to US at the moment. I also think that's unlikely to happen anyway. So if you look at the pattern of US fuel oil purchase in the Middle East at the moment, they're really going direct to supply. So they're taking volumes from Aramco, they're taking volumes from Somo, they're taking volumes from ADNOC. They don't appear to be necessarily dipping into the inventories at Fujairah, where you've got a higher probability that the molecules that are commingled there are not necessarily of a verifiable origin. Therefore, that could potentially create some significant legal risk for any US importers. And just generally speaking, the general market wisdom is that you're not going to risk that sort of potential penalties that you would incur for being involved in that trade, especially when you've still got really good profits. In your crack spreads in the US anyway. So I don't see people, US buyers particularly, wanting to take that risk, and not necessarily, obviously making sure they vet their intermediaries accordingly as well. I don't know, Emma, if you have anything necessary you want to add on that. If not, happy to hand back to you, Might have the question.
Emerald, you want to add anything?
We're not seeing it for the moment, but we'll never know, actually. Looking how structurally, how tight the market in the East is for 380 cutters. So, who knows? But we'll be monitoring the effects of it as we move ahead towards the end of third quarter and fourth quarter, and see how it plays out, actually.
Thank you. Actually, we are running out of time, but quickly we will be asking some of the questions that are in the chat. Thank you so much for your interest, everyone. What is the new outlet for Russian origin VGO, if not US?
Good question. Emerald, do you have any thoughts on that one yourself?
Well, it's difficult because, we are not talking it going to the US, as into gasoline. So it potentially could be going to the African states where there are basic refineries that can refine it into gasoline. But of course, refined fuels have been reported to go into African states. So the output that we are seeing for VGO out of Russia is probably about a tenth of what its fuel oil exports are. So it all depends. It can go into tanks. It can go into simple refineries to at least eke out a good quality specification for gasoline. And we are still looking at it. Where can all the extra molecules go in these times? Yeah.
Yeah, if there's a possibility for blending into the bunker pool as well, there's no shortage of demand for blending components, certainly east of Suez at the moment. That's likely to be a default market, I would have expected, given the current market conditions.
Yeah, precisely.
Thank you so much, both. Thanks a lot for answering the questions, and thank you everybody for attending our today's webinar. It was very, very interactive from your question. I would like to again thank our speakers, and I to assure you that the recording and the resources are going to be shared via the email post the webinar. Just give us a couple of days and you will find it. Thank you everyone for your time today, and hope to see you soon. Have a lovely day. Bye.